Credit cards and credit repair are two essential pillars of personal finance. Understanding how they work can help you build a strong financial foundation and avoid costly mistakes. Credit cards are tools that allow you to borrow money from a bank or financial institution to make purchases. When used responsibly, they offer benefits like cashback, rewards, and fraud protection. However, misusing credit cards, such as missing payments or maxing out your limit, can damage your credit score and lead to high interest debt. Your credit score is a number that reflects your financial reliability. It's calculated based on factors like payment history, credit utilization, length of credit history, types of credit, and recent inquiries. A higher score means better chances of loan approval, lower interest rates, and access to premium financial products. Credit repair is the process of improving your credit score by addressing negative items on your credit report. This includes paying down outstanding balances, disputing inaccurate information, and making consistent on-time payments. You can request a free copy of your credit report from authorized agencies and review it for errors. If you find mistakes, you have the right to dispute them and request corrections. Another effective method is becoming an authorized user on someone else's well-managed credit card. This can add positive history to your report without requiring you to use the card. Additionally, keeping your credit utilization below 30% and avoiding unnecessary hard inquiries can steadily improve your score. In summary, credit cards can be powerful financial tools when used wisely, and credit repair is a strategic process that requires patience and discipline. By understanding these concepts and applying them consistently, you can take control of your financial future. This is Capital Edge Grid, your edge in finance. Subscribe for more insights that build wealth, not just hype.